Thanks for sticking with us after lunch. I'm Rick Schwarck, President and CEO at Absolute Energy, an ethanol plant in St. Ansgar, Iowa. The world is working through one of the largest economic disruptions ever recorded. And every time we think we see the light at the end of the tunnel, another wave of COVID sweeps the globe. The impacts have been felt everywhere, from world commodity markets all the way down to local workplaces. The biofuels industry, at its core, is a commodity business. We buy commodities, process them, and then sell value-added products down the line. Our next speakers are going to share their thoughts on what the economy might be facing as we continue to navigate that uncertainty. Joining me today for the Economic Outlook Roundtable is Dr. Seth Meyer, Chief Economist at the USDA. Dr. Meyer was appointed as USDA's Chief Economist in January of 2020. Previous to the USDA, Dr. Meyer was a research professor and associate director for the Food and Agricultural Policy Research Institute, FAPRI. FAPRI is well known for its agricultural policy and market analysis, being called on by Congress and the USDA for its insight into commodity production, price, farm income, trade impacts, and more. Dr. Meyer?
All right. I haven't been able to unlodge that 2020. It is actually January 3rd of 2021, so I'm coming up on my first year. And I'll jump right in, because they said to keep it quick because we could have more time for Q&A. So this is the title I came up with in terms of hitting the topics that don't necessarily all string together well. So we're going to jump from topic to topic if we need to. So we'll cover a bunch of different areas. And these are the things that are on the top of my mind frame being, while I am living in Columbia, Missouri, my desk is at USDA in Washington, D.C. So this is a bit of a D.C. perspective on some of these things. The first thing that comes to mind for this group that I want to talk about is the RFS. And most recently, this proposed rule that just came out, and you all had an interesting conversation just before lunch on this very subject. And I think what I want to emphasize from you all, is what I show there on the right is what was proposed, what was supposed to be the RFS, and the blue line is what the volume has actually turned out to be. Okay, this is straight out of the EPA's document on the proposed rule. So what first comes to mind is, for the last several years, we have not met the volume that was originally targeted within the RFS. Some of that's been small refinery exemptions, some of it's been adjustment due to COVID demand, but we've never had a point where we've had, 15 billion gallons be 15 billion gallons. If you look at the proposed rule for 2022, and you go all the way into the details, and there's this funny little detail as well in there about small refinery exemptions and what are you projecting for the number of exemptions you'll give. Some of you that are real formula nerds will know it always used to be 0. And when I was at USDA the first time, we had a lot of discussions on that, saying, I don't know how many small refinery exemptions you're going to give, but I know the answer isn't 0. Right, so I think when you look forward to 2022, you see some of those formulas, you see small refinery exemptions, and then you start adding half of the ACE remand, that extra 250 million gallons on top of that. You are talking about a pretty big year-over-year change in what the mandate would actually be for 2022 if that becomes the final rule. So that's the first thing that jumps out to mind to me. The second thing is on the renewable diesel side. This is a slide that I show, and I remind everybody about the ethanol industry in 2007, when we had as much capacity proposed as we had existing. Right? There was an inflection point in 2007, and remember how long it took for that capacity to come online. So some of my view here is not all of that's going to get built under current circumstances. So that's part of it, but it certainly is a driver within the industry. The USDA often puts out long-run baselines, and some of us will call us cautious. We tend to say, hey, this is what we look at when we look at the situation as it stands today. So this wouldn't include things like sustainable aviation fuel, but it does show a big year-over-year increase in soybean oil, but the growth after that isn't large. And that dovetails with the thought that not all of that renewable diesel production capacity is going to be put online. This is much different than some folks will suggest that industry is going to grow incredibly rapidly. It's a different take, okay? Happy to talk about that. The other aspect that I think is interesting about renewable diesel as well too is I'm showing you here all the traditional FAME production of biodiesel and then all the renewable diesel plants in a map. And what are the two things that you take away from this? One, so the renewable diesel is all blue. The two things you take away from this are those blue circles are a lot bigger and they're not located in the Midwest. So my question again is, does this change the dynamic of the crush for soybeans? Does it change the political dynamics? Do you now have a different political dynamic when it comes to petroleum if these renewable diesel plants are actually located next to or even inside the fence of a refinery? Does that change the dynamics for biodiesel versus ethanol in terms of the politics of it? While I said I don't expect there to be continued growth exponential growth on renewable diesel production, I do think so it's going to continue to carry a larger share of the bean value than has been traditional for soybean oil, right? That's the pressure that's going to keep soybean share of crush elevated in the near term. This is just a simple graph of domestic consumption and exports, and I take two things you can see from this. First of all, domestic disappearance has been pretty darn flat despite what would be a growing RFS. Again, that's the adjustment on RFS as applied. You can see the sharp downward demand crush from COVID, and you can see a rebound and that exports are remaining about the same share. When we think a little bit longer term here too, again, not huge growth in ethanol production as it stands under current policy today. We can talk, I'm happy to talk about policy. You all talked about E15 and other regs as well too. This is more of a status quo look at where we're at. The other side of that when it comes to ethanol is that corn demand from China has been incredibly strong, okay, and focused. You went through this period of 2015, and there's lots of reasons that we could go into in detail about why in 2015 the Chinese were bringing in corn equivalents, other things that feed like corn, but they have focused in most recent terms strongly on corn. We kind of think that that continues in the near term as well too, and one of the reasons we think corn exports will be better than we've anticipated in previous years is because of that Chinese demand. Again, ring the bell, move tables, supply chain disruptions, farm PPI, food CPI, food at home, food away from home. We calculate all these statistics. So I've kind of tend to break this down and all the things that are on the top of our mind. And this is tangential to renewable fuels, but something that I think is important to understand is we've gone through three periods. That first period is when COVID struck. And this is the period where I got a lot of press calls that said, hey, I can't buy hamburger. Those cattle producers must be making a ton of money. No, they can't slaughter those animals, and that's why you have this spread between animal prices and ground beef prices, and why you have food away from home decline and food at home jump, and all the shifts in demand that come along with it. Then about the time we start sorting out some of those supply chain issues, commodity prices begin to rise, limiting the ability of food prices to fall a little bit. You know, you've got rising commodity prices about August 20 when the Chinese come in strong to our market for all those commodities. And then as we top those out, we now have concerns about, are there other supply chain issues which are influencing inflation? So we started, keeping an eye on things like labor and cans and pallets, all things affecting the ag sector and its ability to trade and export those things. And then finally, I think this is my final slide. This is a complicated sheet, but really the only two lines that matters is receipts and net returns for producers. You all, as far as, you've got corn and beans as your major feedstocks. From a producer standpoint, receipts still looking good, but almost every line on a crop budget, this is the budget I showed the Secretary of Agriculture to describe this a couple months ago. I could illustrate it by talking about Central Illinois. Almost every line on that budget showing inflationary pressure. I'm expending costs today to think about that crop I'm going to put in the spring that I'm not going to be able to sell until the fall. And you're looking at a potential return squeeze even though prices remaining pretty high relative to where they've been in recent history. So again, from our standpoint, a return squeeze for producers, an element of this, and you can go line by line there and see input price pressure for producers. And then I guess it wasn't my last slide, and the last one that's always on everybody's mind is who's driving. Demand has been a big story for farm income and the farm sector. Domestic demand's been really fabulous, but so has foreign demand. And China coming back into our market, there's a couple ways to read this. Clearly, China coming back into the market was important for our overall ag exports, which are at record levels. Another way to read this graph is that the rest of the folks we export to didn't back off. So we kept a lot of our traditional trade partners outside of China, but clearly trade has been a big influence, China being a big part of that. And I think we'll all agree that we're never quite sure. The transparency into the Chinese market is always lacking, and therefore it poses a risk. Well, I guess I had one more. Climate smart agriculture. Okay, so we have been talking at USDA about climate smart agriculture. I'm happy to talk to you more about this. I show you this graph because USDA is going to put out a bunch of money for climate smart ag pilot programs. In the most simplistic term I can think about equating this to is, we all agree what number 2 yellow corn is, right? We all know what number 2 yellow is. That helps facilitate market transactions. If you can bring some of that facilitation of market transaction and understanding what climate smart ag practices do, can you lower the costs for folks to participate in this, and can you encourage producers to participate because now they're getting a bigger share of the market? Okay, these pilot programs will focus on linking back to producers. That's what's been stated, not in a trading scheme. So these things will be tying them to producers in this first step and understanding how to facilitate those markets. That's all I got. That was pretty quick. So
Very good.
Thank you. Let me sit down.
Thank you, Seth. Next joining us is Dr. Ernie Goss, the Jack McAllister Chair in Economics at Creighton University. Dr. Goss is editor of Economic Trends, an economics newsletter published monthly, and he produces a monthly business conditions index for the entire Midwest. You can also hear Dr. Goss each month on 75 to 100 different radio stations who carry his regional economic report. Dr. Goss?
Okay, thank you. Thanks, Rick. And thanks to all of you for inviting me here or having me here. And thanks to Lisa Kofeld and Rick and Seth and Monique DeVilliers for assisting me. And first off, I go by Ernie. I only ask my wife and kids to call me Dr. Goss. Thank you for that. You know, when you teach undergraduate students, you don't get many laughs, I'll tell you. So any laugh is appreciated, as long as it's not at my expense anyway. Economic Black Swans, you see the title, and Golden Geese. In other words, what are the real dangers out there? Black swans, of course, are events that we really don't expect and are high cost. And of course, those are things, and I'll give it away right now. What's the black swan? Well, as you probably know, there are Olympics going on in China next month. And after that, I'm really concerned. Xi Jinping is no capitalist. And flyovers across Taiwan or anywhere around there is a real concern. And I don't think the rest of the nation understands how we in this part of the country are dependent on agriculture, and agriculture is dependent on exports, and that's the real black swan in my judgment. Now, I've said this for about 6 months now, and all of a sudden I'm thinking, wow, it's getting close to being maybe even true. But let me talk about, it's not true, maybe it's certainly an issue we need to pay attention to, because again, people on the East and West Coast don't understand how this is telegraphed back here to the renewable fuels industry, to agriculture, and to all of us. So the 2022 challenges, one of the first ones is inflation. Now, a little bit of inflation is good. No doubt about it for agriculture. Now you say, well, what's a little bit? 2 to 3%. Now the Fed's goal target is 2%. 2 to 3 works for agriculture. 7% does not work for agriculture. Now why does, and it doesn't work for much of anything unless you're buying adjustable rate, unless you have you're lending at adjustable rates. But nonetheless, that's an issue. going forward because the Federal Reserve is raising rates. Tomorrow they'll release their decision for today and tomorrow, and that decision is, well, we've decided to do nothing. We hope that's what they say. Now, they could shock us, but interest rates will be rising. We know that. Let me give it, okay. And the other, of course, commercial real estate is a big issue in the urban areas of this state and other states, and it is really seriously underwater. We have companies that are now, of course, virtual. Employees, Mutual of Omaha, for example, in Omaha, is now virtual. Their employees are working from home. That means there's a huge swath of commercial real estate in Omaha that's problematic. Here's this. Supply chain disruptions. We do a survey of bank CEOs in rural areas of 10 states, as Rick was saying, and we ask, what's the biggest challenge for farmers in 2022? And the number one was supply chain disruptions and what that does to input prices. In other words, fertilizers. You don't need an economist to tell you about fertilizer costs are going up. They're going up at incredible paces, an incredible pace. And that's one of the biggest challenges right there. Next along the list was input prices. Rising interest rates was the next challenge. Now looking at the next one here, we go with federal debt. I mean, here's the chief economist for Richard Nixon, named Herb Stein. He was followed by his famous son, Ben Stein, comedian. And Herb might have been a comedian when he said this. If something can't, this is economic genius now. If something can't go on forever, it will stop. Now, thank you for that. I did hear a laugh. It is comical, but it's also true. It's also true. You cannot continue to spend at this pace and have no consequences. So when will you know when it's coming? When does the consequence hit you? When does it hit the farm? Well, keep an eye on the 10-year Treasury. The yield on the 10-year Treasury tells you more than anything Ernie Goss will ever tell you. And that the rate right now, the yield, is 1.75% approximately. When it hits 2%, watch out. Watch out. Well, that will increase. If it went back to the historical norm, just back to the average, we couldn't afford it. That would be about $500 billion a year that the federal government would have to pay out in interest payments. We couldn't afford it. Now, I'm not saying it'd be cataclysmic. I'm saying it'd be problematic. And the problem would be either increasing taxes, increasing inflation, or we have higher interest rates. Those are the three outcomes. And we have, let me just show you my next one. Let me see, on there, I'm looking at, by the way, the federal debt. Modern monetary theory. You find me an economist that says that's okay. When you meet that guy or gal, you step back one pace, put your hand on your wallet, turn around and run. It's nonsense. We cannot continue. The Federal Reserve increased the money supply by 35 to 40% since February of 2020. Now, again, you don't need an economist to tell you that can't happen. It can't continue. Somehow that has to be withdrawn. Now, I'm sorry, but Lisa asked me to be positive, and Monique is going to let me know when I've got 10 seconds to go, and I'll give you the positive side of my presentation. So, anyway, yeah, but here, Democrats agree on BBB, Biden's Build Back Better. I call it Biden's budget busting blunder. Sorry about that, the BBBs. It's not. He can't do it. And he's had two people, and I'm sorry, I don't mean to get political, that have saved his, I grew up in Georgia, saved his rusty butt. How's that? And that's Christine Sinema, Senator, and more in line with Manchin in West Virginia. This would be devastating. It would have been devastating to the Biden's reelection. Of course, there are other things that might be more damaging to his reelection campaign, like his age, but that's another issue. Let's don't go there. Higher pay for remaining out of work. what happened between the Trump administration, the Biden administration, and what's going on still is paying people, and they say, well, I thought they cut that back. They did cut it back, but it's still, we increased the savings rate during the pandemic, the savings rate now, about up to the highest, up to record levels. In other words, we were paying individuals $1,400 a person just for filing a tax return. And if you didn't file a tax return, you could still get it. Paying 20%. And the other thing is 60% of Americans are no longer paying or didn't pay income taxes in 2020. This is a real problem. It's a real problem. And it's how does it show up in our area? Bankers, these are CEOs, bank CEOs in rural areas of 10 states, tell us their second biggest problem is finding and hiring qualified workers. There's a serious shortage of workers, whether it's your dry cleaning establishment, whether it's your restaurant, whatever. It's a serious issue. We've got to remedy that. Normally, people in my age group, that's baby boomers, when we retire, we would have ordinarily come back in. We have not come back into the labor market. We need to get those guys and gals back into the labor market because, as you know, for example, the state I live in has the lowest unemployment rate in America. But that's not a good positive signal necessarily because that indicates we have labor shortages right now. We need more of that. So anyway, next slide. I'll go through quickly now. There's what the federal stimulus did. This is the yield on the 10-year Treasury. The yield is 1.75. What this has done, and here's the issue, over savings by Chinese, Japanese, Europeans, whomever, they're funding our deficit. And also the Federal Reserve. When the Treasury spends the money, who pays for it? Well, to a large degree, the foreigners, the Chinese, and so on. I have to go quickly. And there's the yield on the short term. They're going to raise the rates on the short term. It's now 6 basis points. And then on the long term, 1.75. Those are almost record lows. So get ready for higher interest rates. So when your banker says, what do you need a loan for? Just say, I just need it. Borrow now. Borrow on fixed rates. Do not borrow on adjustable rates. Now, the total federal deficit, I won't go into this. You see that. Negative. The deficit's actually, President Biden is taking credit, and perhaps he should, for reducing the deficit. But there's still the largest deficits we've seen since World War II. So that's a threat. Now, looking at our surveys, these are Creighton University surveys. I'll tell you what, the latest one just came out. But look at that. That's the national number. 50 is growth neutral. I mean, can you imagine when we get into the pandemic that we could even be standing on our feet? Not only are we standing on our feet, we're doing well. Well, this is a survey of manufacturers. Now, here's the Mid-American. That includes Iowa. We're doing fantastic given what has happened to us. Who could have ever? And there is no economist on the face of the earth that could have predicted this. This meaning you have a surplus in your state coffers. Unbelievable. Your governor's talking about cutting income taxes. And now, where's those funds come from, of course? Unfortunately, some of those funds, a lot of them, came from the federal government. Okay, here's the rural one. This is the rural one. Look at that, 66.7. The number that we just sent out this week was down a bit, but still positive. The rural areas are growing despite the labor shortages, despite the supply chain disruptions, and as long as we see exports continuing to hold up, as long as we see inflation coming down, it has to come down from 7%. You say, how low? We need to see it down by below 4 by the end of the year, in my judgment, below 4. In fact, again, 2 to 3% is fine for agriculture, in my judgment. So with that, and there you see a way you can sign up for my newsletter. It's, as the dean's asked me to put on there, free and well worth the price. And it is well worth that price. And it's a monthly newsletter we don't have any advertisements. I don't turn your name over to anybody. I'm not that sophisticated. I couldn't do it. And we do monthly essays. This essay this month was on inflation. Now again, that's easy pickings. Inflation. And it's too high. It's been too high for too long. The head of the Federal Reserve said it's transitory. That's what he said initially. Life is transitory. Depends on your time frame. And the time frame he was talking about is longer than we thought. And this transitory inflation, in my judgment, is at least going into the end of 2022. And it's going to come down. That rate is probably not going to come down in the next couple of months. Oil prices are going up, which is certainly not bad for ethanol, and saluting ethanol. And by the way, I work with a company here, Eco Engineers, Sashi Biodigestive Systems. We've done different states. Man, this is the center of renewable fuels for America. How in the heck can you go wrong with that? How in the heck can you not get excited? That's my 10 cent, right? I got it? Okay, go ahead. Okay. No, but how can you not get excited about being part of this industry? This industry being renewable fuels. And as we drove across, it's amazing. People on the east and west coast, as Zuckerberg said, Zuckerberg from Facebook started out in Silicon Valley and drove across country. He said, you can't believe it. They have these places along the highway where you can actually go in and take a shower, a truck stop. He says, they got a shower there. And I'm thinking, wow, that is amazing, isn't it? He needs to wake up. Those have been there for about 50 years now. So anyway, they're not always in tune with what is going on here. So with that, I'll stop and I guess take questions. Is that?
Yeah. Thank you, Seth. Thank you, Ernie. We'll now take questions from the audience. If you have a question, please make your way to a microphone on either side of the hall here, please. State your name, give your affiliation, and then your question, please. I'll begin. Dr. Meyer, we had a somewhat unique period at the end of 2021 where corn prices were high, despite a surprisingly good harvest, but ethanol margins were also very strong. It was a truly good time for the farmer and good for the plant. Do you view that as a temporary set of circumstances, or is it durable?
Well, so I guess it would depend on, again, we think oil prices are going to remain high. I think they've seen some benefits from corn oil extraction and some other ways to support that. We have decent trade, demand is rebounding. So I hate to call anything in the kind of environment we've had with demand swings, but it seems that despite the fact that we've got these higher corn prices, they continue to have solid returns. So as long as those pieces all stay together, it might be good for the near term anyway.
And I would say, to add to that, exports are an issue, even though the share of the ethanol that's exported is not that large, but nonetheless, that's really very important, yeah. And I'm concerned about that going forward.
And I think domestic demand is awfully tied back to our ability to put more through. You had your E15 discussion this morning, and despite what I see as a bump up in domestic requirements under the RFS, I think that's hard to achieve with domestic consumption, but they'll continue to try and push that as well too. That's not irrelevant to this profitability as well too, folks trying to get ready and push through some of that increased volume for 2022.
Thank you. We have a question.
Thank you. Borrow early and borrow often is a good response right now. My concern is when the reins get pulled on this inflationary status, could we get into a deflationary system that could really make you sorry for doing that going forward?
I think there's every possibility of that, but it's going to be a couple of years for that. But that's absolutely what we could be facing. In other words, this deflationary period. And as I said, and as you know better than I, inflation at 1.5% or lower has been devastating to, for example, Japan. It would be, I won't say devastating to us, but it would certainly be an issue. We want to see it higher, and the Fed shoots for higher. The Fed is shooting, and their target is 2%. So I think that's it's like me shooting a weapon at a bullseye. It's not that easy for me anyway, and I don't think it's that easy for the Fed. And I think that we have this glut of global savings, and that's not going to go away. And that's going to support lower and lower interest rates beyond what we're talking about now, beyond this, say, couple of years. I'm talking about 2 to 3 years out, what we could see. Yes.
Thank you. Did you have any thoughts on that?
No, no.
All right, very good.
And also, as part of that, is cheaper grain prices, for example, could also be part of that. I mean, in other words, if you look at what happened in agriculture, look what went on in agriculture between 2014 and, say, 2018, 19. We didn't see good prices. Now we've seen good prices since then. So.
Continuing on the inflation thought here, we've kind of returned to those levels that we saw in the 70s and 80s.
Yeah.
How do you see that impacting things right down on the farm and at the local ethanol plant and in rural America?
Well, I guess I'll stick on the farm and I have pointed out this return squeeze. And normally when you go through your crop budget, you're used to it going up a little bit, costs rise over time. But usually there's something you can hang your hat on and saying, well, this looks a little bit better this year. You go to that corn and soybean budget, you go all the way through it, every one of them's higher. Some of them by a significant amount in terms of fertilizer. You're putting your spending in that now, and you're not getting that crop until, you're already seeing the expenses, you're not going to harvest that until the fall. So I think that absolutely there is a potential for a squeeze there that we need to keep an eye on.
Well, I think there is certainly that potential for a squeeze with inflation coming down. So I expect it, but not in the first or second quarter. I think we're talking about the third quarter of 2022, and what that means in terms of cost. But fertilizer costs and insecticide, other input costs, I think are putting a squeeze. Now I have no idea what price of corn, for example, a bushel of corn going forward is, but we're talking about some pretty good numbers right now in soybean, corn, and wheat, of course. And the question that sometimes I'm asked, and which I can't answer, is what will because of these input prices, will farmers move from corn to soybean? I mean, gosh, I don't know. I don't know.
And the corn to soybean, I mean, we went through a period where China was buying, pre-friction and post-friction, where beans were getting a premium in the price ratio. We're sitting right now that strength in corn is still pretty good. Mm-hmm. I think, we maybe will see some folks take a look at this inflation, fertilizer costs, and say, maybe I'll be more deliberate in my fertilizer application. But right now, it's a pretty strong signal. You're right, prices may come down with the next harvest, but they're still good prices relative to where we were in that 14 to 18 period.
And look at housing prices. Urban areas, 19% year-over-year growth. Well, you look in these communities, our surveys indicate housing, even in these rural communities, small towns, rural areas, growing at an unprecedented pace, And what does that do to the individual in terms of qualifying for a loan and paying for that? And rentals. Rentals are growing at we haven't seen the end of that, nor have we seen the end of the price increases in housing. It's remarkable how long it's gone on and how much longer it's likely to go on. That's one of the areas I would not advise anybody to invest in that market. But if you need a house now, it won't get any cheaper this year. And by the way, before I forget it, I do have one nugget I stumbled upon. If you want to, if you protect yourself against inflation, buy the I-bonds. And you're familiar with those, Rick. The I-bonds, you can only buy $10,000 a person, so you could buy it for your spouse and yourself and your kids. I think that's right. I'm not sure. $10,000 a piece. It's now paying 7.2% interest. Now, where in the heck can you get that? And they lock it in for a year. They'll give you high. So anyway.
Very good point. Do we have another question?
Yeah, hi, it's John Norwood, and I appreciate the discussion here with Dr. Seth and Dr. Ernie. I guess the graph that struck me the most was Dr. Seth, your slide that showed the marketplace, and particularly the volatility of the the value of the buying with China. So I'm wondering if you could talk a little bit more about, and I think I quoted you on risk. China's a risk factor, and how much are we running the system on one buyer that may or may not buy, and what does that do to inflation and so forth?
Oh, no, absolutely. And we talk, trade's absolutely important for this sector.
Crucial.
And you've got a lot of eggs in one basket. I'll go back and tell you a story. I was lucky enough to be traveling in the countryside in Uruguay right after we had trade friction with China. They were happy to be getting that price premium for their soybeans as the Chinese were coming to them. They were happy, but they didn't want that to be the long run position, because it's not great to have all your eggs in one basket with a country who you lack transparency into. I think it's a real risk. I mean, at USDA, we do attempt to predict how many grain stocks they have, but to be fair, it is difficult to determine. We don't have full transparency into their marketplace. They have a TRQ on corn, that's 7.5 million metric tons. Everything under 7.5 million metric tons comes in at a low rate, and then everything above that is at the government's discretion. They've never announced that they're going to raise that quota, and yet they imported, instead of 7.5 million metric tons, nearly 30 million metric tons. So the government has never announced they're going to import more. So I think that there is a tremendous risk there for any number of reasons, including our lack of transparency and understanding that our ability to see into that marketplace.
And I think it's very important to recognize that Xi Jinping, the head of the Chinese Communist Party, is no capitalist. In fact, he's the most, in my judgment, and others, he's the most radical to the left person, anti-market person, the head of the Communist Party in China since Mao Zedong. I mean, we're talking about, and so what may be irrational to us may be rational to him. He appears to care more about controlling the economy rather than having the economy flourish. So that's my concern. Again, as I said, Black Swan event post-Olympics in China, and that's, as you say, that gets telegraphed back here. The Chinese are buying a heck of a lot of our agricultural goods, and that's been very supportive of the rural areas of this country.
And I think for us, the next move is, okay, diversification, right? Let's keep those markets we got, but let's diversify as well too.
Yeah.
Are there other locations in Southeast Asia where we can facilitate trade of U.S. agricultural products, and they'll grow and they want our product? And use that as a way to diversify. Keep what you got and spread it around.
See, we have another question.
Yes, Warren Pitcher from West Des Moines. I'd like to have the panel address this extreme shortage of employees in all sections of our economy. At one time they were talking about a $15 an hour minimum wage. Well, I see $15 an hour in windows at McDonald's starting pay. I see a billboard that Perishable Distributors of Iowa will pay $30 an hour to drive a truck for 4 days a week and be home every night. What I'm trying to get to is, how do you think we can match the people that don't have needed or any skills, let's be honest, that an employer can justify the 15, leave alone the $30 an hour? And also, how many years do you think we're going to have this employee shortage? Thank you.
Good question. Ernie, you
I
want to
think
start?
certainly what's causing the shortage. One is COVID-19, of course, individuals that have not returned because of the fear of contraction of the disease. Secondly is child care, finding child care, so men and women are staying home because of the lack of adequate child care. Third is, which is we can change, is we're incentivizing individuals. The gap between what you make and what you get from support from the government is too small. Now, I'm not saying it's not like this, but there is a gap there. We need to close that gap by increasing pay. Now, I think I've seen $20 an hour at McDonald's, for example. So that's a real key, particularly for this part of the country. The bankers that we survey, the manufacturers that we survey, say they can't get workers. But also to your point about truckers, getting truck drivers, there are some regulatory issues that the federal government needs to examine particularly at the ports of Long Beach and Los Angeles, but also other ports across the U.S. So that remains probably one of the biggest bottlenecks, second only to supply chain disruptions. Of course, that's part of the supply chain disruptions. It's also part of the inflation. What happens for economists, you hear Jay Powell saying transitory, and you hear the president say transitory. The reason they're saying that is once you and I begin to expect higher inflation, all of a sudden Creighton University says, we're giving you 3% this year, Ernie. And I'm like, baloney, inflation's at 6 or 7, I want more. So when you start seeing McDonald's from $20 to $30 an hour, then it becomes the 70s and the 80s. And those of us who were there at that time remember what happened. We brought in Volcker, who big, tall, I think he was a Texan, I'm not sure, cigar chomping guy. He said, I'll get it straight. He did. He raised interest rates. The mortgage rates went to 16%. Now, can you imagine paying 16% versus what you're now paying over between 3 and 4%? That is entirely possible if it does become wedded in, if it does become part of our expectations as part of individuals going to work. But also something I didn't say is immigration. We've been, despite the illegal or whatever you wish to call it, migration coming across the border, we've been tougher in migration, legal migration coming into the U.S. That's a source of expansion in my judgment.
Thank you. Thoughts on that, Seth?
I'll just add that at USDA, we do look at a couple places of critical importance to maintain opportunities to grow a workforce. And I think for us, it tends to be in places like truck driving and maybe even some special skilled truck driving. I don't think everybody knows how to haul cattle. So we think about things like special needs in terms of trucking and facilitating movement of commodities. And then on top of that, I think another place where we are spending time focusing on is labor in terms of meat and poultry processing, slaughter, and the ability to keep those plants staffed, operated with good jobs for those workers as well. Because I think those two things are very critical for U.S. agriculture.
Okay. We have one more quick question, please.
So, Dr. Goss, the interest rates actually went to 18%. I've got the paper to prove it. And my question to you is, the Farm Credit System charges me 200 basis points if I want to go from my variable rate notes to fix them. Should I take that bet, or do you think over the next few years we can't afford 2 full points of interest increase?
2% addition, that gets us back to about normal rates, if you will. The normal, when I'm speaking of normal, I'm speaking of post-2000. So we're talking about 200 basis points, 2 percentage points. We're back to normal then. I mean, that's hard. Can you imagine individuals in my class? I'm teaching undergraduates, a few undergraduates right now. They have no idea about interest rates that are pre-2000, which were much higher, and we're going to see those. So if I'm borrowing now, I'm locking in long-term rates, even in cases 2 percentage points above. Now, back to the question earlier about are we long-term going back to this over savings environment? And we may be going back there too. So I would be reluctant to lock in anything 2 percentage points higher for very long. I would do it for 2, 3, 4 years. Beyond that, no. I'm a concern. I think interest rates may well come back because of the issues brought up by an audience member earlier.
Thank you very much for the questions, folks. Join me in thanking Dr. Seth Myers and Dr. Ernie Goss, great resources.
Thank you.